able to help many people in the community in terms of how to take care of their finances, what needs to be done for the kids' education, retirement, long-term. There's a lot of stuff that I've actually helped people with. So today's journey is mostly focused on not on my real estate investments and mostly on financial consulting, what I'm doing and how I can help people. So this is very interesting. I did share this pretty much all my sessions because a lot of people calls me back and say, Giri, whatever you shared about your journey, it exactly like mine, and we sync with what the pointers, correct? So I came in 2006 as immigrant to US and got my green card process started in 2007. I got my house in 2011. Look at this one. I got my full-time job in 2012. 2013, I started my first retirement saving. 2006 to 2013, no savings for retirement. All the money I saved, all used to buy, send it to India, buy lands, buy some properties and building a house there. All my mind, I will go back to India kind of thing, correct? All the time, confusion state, I want to go back to India. When I talk to people around 40 years, 45 years old people, many of the people who are in H1 and not sure about the immigration status, always they say is, I want to go back to India next 2 years or 3 years. And when the people I meet around 48, 50 years old, they say, you know what, almost 10 years, I want to go back to India. I put all the money there. I don't know what to do with that money now. I can't bring it back. I can't go back, live there, and all the challenges, correct? So same thing. I'm not different than any of you, correct? It's a similar kind of mindset. Until 2013, I missed the opportunity to invest and grow the money. And in 2014, I took a term life insurance. Interesting why I'm saying all these things is in 2000, when I got my full-time job, you know what I decided? What are the things I need to take care if I want to live in America, correct? One is I need to have retirement money. I need to have a kids' educational plan. I need to have life insurance for myself. For example, I bought a house, something happens to me. I don't want to create a burden for my family. I need to have life insurance as well. And also I realized that will and trust estate planning is very, very important piece in financial planning. So I took care of that in 2015. So a lot of people, I would say 99% people in the Indian community haven't done anything in the estate planning side of it. So another unfortunate thing, people are not aware of it. Does it take a lot of time? Probably not. It may take a couple of years, couple of hours to finish it, but people don't do that because they don't know what to do, correct? So what we're doing in so far is we've been educating people about tax side of it, talking about life insurance, talking about estate planning side of it, talk about kids education planning, talk about investment strategies. As an advisor, I've been doing this. As Deepti mentioned, our goal this year is to educate at least 5,000 families. My lifetime goal is 1 million families impacting, correct? So it is a long way to go, but I think I don't want to settle down for, let me help 1,000 people, 2,000 people, 100,000 people. I really want to go bigger and then help create a bigger impact on the community. So I really want to thank Swara Media for giving an opportunity for me to share today, because this is another way of reaching out to bigger audience. That is, it is recorded, it is televised in Facebook and YouTube. That means it is going to be there forever. Maybe hundreds of people are going to listen to this in the future. So I'm very happy about this opportunity, and I'm really wanted to give some information, some takeaways for each one of you today, so you can go back and look at them and then see retrospect on them, what you're doing. Okay.
So how is the current market in US, Giri?
So this is a good question, Deepti. Actually, I do have a slide on this. I talk about that. So current market conditions, correct? A lot of people think about, is it going up or going down? Should I put the money? Is it right time to buy stocks or real estate? Let us talk about some of the statistics that will give a perspective to that. Interesting is, I took this in last year when market is down, correct? In 2020, when the pandemic is kind of a crazy, don't know what is going to happen. Look at this one. Interesting thing is, Rent and Mortgage Cancellation Act. 5,000% month on month. What does it mean? Generally in the market, people don't pay rents, correct? People don't pay mortgages because of the difficult situations in finances. 5,000% increase because of the pandemic in 1 month, correct? It's so huge, basically. So uncertainty comes like that. People don't have emergency fund. They don't even keep the money for 6 months to take care of their finances, correct? They defaulted their mortgages. Now, if you look at the other one, 130% month on month, emergency food stamps. People who depend on, don't have money, they don't have enough money for taking care of their livelihood, they depend on government food stamps, correct? 130% increased. in just 1 month, correct? Look at this one, 5,000% increase in month on month for withdrawal on 401k. 401k is generally designed for retirement. People don't touch it until age 60, 59 and a half. But because of the pandemic, people started withdrawing because they don't have opportunity to, they don't have any savings to take care of themselves, correct? So this is a scary thing, actually speaking, correct? That means I have another slide after this. What are the percentage of people having really savings towards retirement? How much debt people have it really in America, correct? Next one is a lot of people joined, 200% people joined to learn something about finances. I was actually happy to see this slide. You know what? My goal is to also educate, empower people about finances, educating about importance of finances. That people started joining, learning about more about finances because of the pandemic. What will happen to me in future? Interesting thing is many of my classmates lost their job during pandemic, and it took almost 9 months to 10 months for them to get to the job market back. So it is challenging sometime. The market is down. It could be possible they cannot pay their mortgages, they can't send kids to the college. A lot of challenges are there. Definitely, the pandemic really shown us why everyone should be prepared well for in finances, know what needs to be done, how to keep emergency fund, are you doing finances rightly, are you putting everything in one bucket, those kind of things is very important. So I also want to share some interesting stats here. Deepti is Fannie Maker, you know about real estate mortgage company here. Interesting stats here is over 64% buyers think is a bad time to buy real estate. But 77% people think this is a great time to sell. See, this is the imperative there, correct? So there is an imbalance between what buyers think and what sellers think in the real estate market. Another thing I want to talk about the inflation. Inflation is cost of living, correct? Today, I'm going to spend $1 to buy an apple. In next year, how much is it going to cost to buy an apple, correct? Look at this, it is increased by 5.3% in last 12 months, basically 5.3%. And the average, if generally historically, if you see, we talk about 1.7, 2.5, or 3% is the maximum that we consider for inflation, cost of living increase. But because of the pandemic, because of the lot of stimulus checks and what is happening, debt is increasing in the US government, 5.3% inflation. So if you are costing $100 this year, next year is going to cost $105.30 to do the exact same thing, correct? So that means your cost of living is increasing. Are our salaries are increasing like that? Probably not. The income is increasing like that? It is not. Probably 2% hike, 1% hike because of the pandemic. So it is important to understand the imperatives between how income is growing versus how the inflation is growing, correct? So unemployment rate, another important thing about unemployment rate, correct? In 2020, it was the highest ever since 1948. Correct. Now we come back to July 2021, is around 2% above the pre-pandemic level, correct? Before 2020. So there is also people are losing jobs. They're concerned about getting back into the market, job market. Interesting thing, if people are young, let's say 35, 40-year-old, they have energy, drive towards learning new technology, competing with other people, get into the job. So my concern generally is people who are already into, let's say, 50s, now they lose the job, for example. What are they going to do? Are you going to compete with 35, 40-year-old smart people with less salaries? It is not. It is kind of impossible, correct? So my concern for people is understanding this importance of financial planning, have the emergency fund, put funds in right bucket so that even if the things happens like this, like pandemic, you are ready to take care of it without impacting the finances, without impacting your emotional, creating emotional stress for you and your family. That's very important. Okay. So if you look at this, what I'm talking about is the median retirement saving for the US is, look at this one. Even the people at 60 years old, the average saving, their median saving is $172,000. People at 40s have 63. This is not for, I would say, not for us, because Indian community generally are good in savings. Maybe you save much more money than this. But again, understanding how the market is, and now because of this, what is going to happen? All these people are going to depend on government, right, for long-term care expenses. What does it mean? Government don't have infinite funds. What they're going to do? They're going to increase taxes. People who are saving money will be penalized sometime to pay extra taxes to take care of the other benefits for the community. So this is important. Last one I want to talk about here is, look at the student loan debt. There are 45 million borrowers are there, $1.6 trillion debt. This interesting stats I want to show you is, people with 50 to 61 years old, there are 6 million people still owe the debt, student debt. Think about that. People over 62 years old also own $2.1 million. 2.1 million people are there having student debt. We always think student debt means we're done with the college, we get the job, we pay off. But if you look at these statistics, this is really scary. How they're going to take care of retirement when they have this much debt for the student loan? Correct? This is very scary thing. So why I'm talking about all these scary numbers is, to take care of the community, take care of the people, government has to have some subsidies to do all of this. What is going to happen? How are they going to refill that gap, correct? Generally by increasing the taxes. That's why you talk about Biden government. They are going to repeal all the TCJA, Tax Cuts and Job Acts. They launched in 2019, is going to go away in 2025. From 2026 onwards, there's going to be brand new tax strategies. Even as yesterday I was talking to, attending one of the seminars about how the taxes are going to go for wealthy individuals. Totally different. They're increasing taxes. They created brand new 2 tax slabs. Earlier, 37% is the maximum tax. Now they gone to 42, 44% also for wealthy people. So there's no limit. They have to cover cost somewhere else to fill this debt basically.
And then what are the factors should we know while considering financial products?
Very good, Deepti. As I mentioned before, everybody's needs are different. They may be in different stage of life. For example, I have 2 boys. One is he's in high school, he's in 11th grade. Another one is in 7th grade. My primary goal at this point of time is, how can I send my kids to a good college, correct? How much is it going to cost? I have to save money for that. That's the important thing. I don't have a lot of time for my kids' education. I have only 2 years. Whereas for my retirement, I have my 15 years, 20 years now, correct? So based on the needs, based on where they stand today, they have a different factors they should consider. So if you ask me, any investment, forget about whether it is stocks, mutual funds, real estate. These are the 4 things generally I suggest people to think about. One is how money grows. Understand this. Are you getting 3% growth, 6% growth, 12% growth? That will tell you how money is going to grow, how long is it going to take you to go to the where you want to get through. Number 2 is impact of losses. If you lose money, let us say stock market line last year, 2020, just for a week, 2 weeks, market crashed 30%, correct? So when you lose the money, what if it didn't market come back to normal again? Are you willing to take are you okay to take the impact of losses? Are you ready to really sustain the 30% hit on yourself? In 2008, we almost at 50%. Are you ready to take the 50% hit kind of thing, correct? It's very important to understand. Third one is taxes. Some of them are tax deferred, like 401ks, IRAs. Some of them are taxable. For example, you put money in Tesla stock and it gone to $1,100 yesterday. If I sell the Tesla stock, I'm going to pay capital gain tax. Then you not really got that 30% growth. You actually have to pay 20% tax on top of it. So important understanding what are the tax advantages that you have, what vehicles you can choose for leveraging the taxes. And then also the inflation, correct? As I mentioned, 5.3 inflation, 5.3% inflation. So when I ask me, hey, how much wealth I have, I always look at how much money you have in the bank. Let us say in stock market, let's say I have $1 million I have in stocks, minus how much taxes you are going to pay when you sell the stocks, because you're going to use them for you, minus what is the inflation that you have today. That is all important. That is the number you should consider for your wealth, basically. So these 4. What I will do, Deepti, I will talk about these 4 things today, little bit more perspective to the people attending. So there may be people know about some of them, but I wanted to recap, what is the importance of how the money grows in simple way, and then talk about what will happen when you lose the money, talk about a little bit of tax structure. So why I'm talking about these things is I do financial planning for many people for more than 15, 16 states all over the years. I ask people, do you know the difference between IRA and Roth IRA? Most of people say, I know what they are, but don't know how they work. The one thing, correct? Number 2 is, what is Roth? People ask the question, what is Roth? At least 20% people say, what is Roth? You never heard of Roth, basically, correct? So it is important for us to understand the basics of fundamentals before we talk about where to put money kind of thing. Okay. So if you look at the rule of 72, maybe some of them know it. This is really, really fun for math for me because I'm an engineer by profession. I look at this, wow, this is very fun, amazing to look at this. What the rule of 72 says is, if you get 4% return on your investments, 4% return per year in investments, 72 divided by 4 is 18. It takes 18 years to double the money. So every 18 years, your money will become double. $10,000 will become 20,000, $20,000 will become 40,000. Okay. If you return, you're going to get 8% return. 70 divided by 8 is 9 years. Every 9 years, your money is going to double. 10,000 will become 20, 40, 80, 160K. By the time you become 65. See this again? The person with the 4% conservative investments and returns got 40,000. Whereas a little bit aggressive investments, or I don't say aggressive, proper investments, understanding the importance of how to leverage the products, 8% rate of return, got 160K. Yeah. Now, what about 12%? 70 divided by 12 is 6. Same number of years, 29 to 65, they got 640K. So we are talking about only money growing, correct? What about when you take the money from the bank? What will happen? Very different way of perspective. This is growing the money, understood? I put some interesting, fun example here. Maybe you all like it. So this is serious stuff, but you make it easier. Let us say we have Winnie the Pooh, correct? A lot of people know. Let us say Winnie the Pooh is very conservative. They don't want to lose any money. They have $10,000. Winnie the Pooh put into the bank account. How much the bank gives generally? 0.25%, 0.5%, very, very less amount. Winnie the Pooh is a little smarter. You know what they did? He put in CD, certificate of deposit, like fixed deposit. Generally, banks give around 2%, 2.5% CD rates to the Winnie the Pooh, correct? Based on rule of 72, 72 divided by 2, it takes 36 years to make 10,000 become 20,000. Correct? Very interesting to hear. Now, what does the bank do? They give it to the car loans, they give personal loans, they give mortgage loans, they give credit card loans. They do a lot of loans here in the right side of it. What happens with this one? Tigger said they want some money. They want to get a credit card loan. They took $10,000 credit card loan from the bank. What happens now? 12% they have to pay, 24%, 18% APR, correct? Generally for the credit cards. 72 divided by 12 means 6 years. That means in 36 years, the Tigger is going to pay 640K. 640K debt they're going to pay. Look at the Winnie the Pooh, got $20,000 return, whereas Tigger has to pay 64 times 10,000. So much impact in the debt side of it. So why I'm talking about this funny thing is, if you're earning money, investing money, we have to try to increase this one. When you're taking the money from the bank or lender, our goal is to reduce this one. That's why, part of the financial planning, Deepti, we always talk about what is the first thing. One is having a protection, taking care of your family. Number 2, we talk about is create emergency fund. At least something happens, pandemic, losing a job, health issues, you should have at least 3 to 6 months of money as emergency fund. Number 3 is debt management. So if you have a higher interest debts, you are actually, there is no vehicle that I know at this point of time where they guarantee 12% return. Nothing there. Nothing guaranteed 12%. But in case of banks, you are guaranteed to pay 12%. Correct? So important thing to understand, what are the vehicles that you have today? If you're paying 12% interest rate on a credit card or any other loans, try to eliminate them. That's what we teach people about, how to eliminate the debt, consolidate the debt, basically. So the next one is about impact of losses. If I had $10,000 money, I lost 50%. Now it becomes $5,000 in the stock market. If I want to get back to 10,000, if you gain 50%, see this one, I got 50% loss. Now I got 50% gain. What happens? I only got $2,500 on this. That means my net is going to be only $7,500. If I lose 50%, if I want to go back to 100%, which is a 10K back, break even, I have to get 100% gain. Think about this, correct? 100% gain. When losing is not like 50-50. I lose 50, I get 50. You are not going to get to the break even. You have to gain 100% to get to the break even. So a lot of people don't understand this. Basically, it's very important to understand impact of losses are much bigger than the gain that you see generally. So a lot of people ask us, what are the options, correct? Generally, people very conservative, they go into the fixed interest. They put into CD, savings, where they get 0.5% or 2% growth. Whatever happens to the market, no problem. They get the guaranteed 2% income. In case of variable, like stocks, mutual funds, ETFs, market go up, your portfolio will go up. When market goes down, it will go down. Up and down, there's no control of this. The third option, what people leverage this is, when market go up, it will go up. When market goes down, you don't go down, you stay there. You lock your number there. When market comes back up again, you start growing up again. Correct? So this is a hybrid between the fixed as well as the variable. This is called indexed, basically. At any point of time, you are not seeing a negative, you're only seeing the positive side of it. There are some products available to take care of these indexed products. We can talk about them later as part of the presentation. Just to have a perspective on this, correct? What are the options that we have? Fixed, variable with the high risk, and indexed with the no risk kind of thing here. Here also no risk here, basically. Okay. The third one I want to talk about is the taxes. As I mentioned, if you don't understand the taxes, you really don't know where you are putting money. Is it good for you, bad for you? Correct? Tax strategy is very important. I want to quickly talk about something about what are the buckets available, and then what are the products available in different tax structure. One is taxable, correct? We have savings, CDs, mutual fund stocks, all of them are taxable. When you put the money, you grow the money, you pay the capital gain tax, you reinvest again, you grow the money, you pay tax again. It's called taxable income. You keep paying taxes again and again for the growth. Whereas tax deferred, like 401k, IRA, and annuities, what happens here? You put the money, pre-tax money. You don't pay tax when you invest the money. The money will keep growing. But when you take the money out during retirement or anytime before or after, you have to pay the taxes. It's called tax deferred accounts, basically. 401k, generally we know about 401k. People working in the government also do 401(3)(b)s. IRS, FIRS is different again. People do it. When it comes to the tax advantage bucket, a lot of people not aware of this is municipal bonds. You're putting the post-tax money, how much ever it grows, you don't pay taxes anymore. Okay. Now, Rath IR, Rath 401k, same thing. You put the post-tax money, whatever the money grows, you don't pay taxes. Same thing with the kids' college planning, 5 to 9 plans. You put the money post-tax, whatever the money it grows, you don't pay taxes. And the last one here is 7702, which is basically something like a tax code called 401k IRA. 7702 is a tax code in the IRS books. 7702 is basically the cash value life insurance policies like variable universal life, index universal life, whole life. These are the cash value life insurance policies. A lot of people not aware of this. I was thinking, oh, do you have something like this in the US? Yeah, there are a lot of powerful products available in the market. I'm going to talk about this later on in the presentation. So just to have perspective of how the tax structure is. So interesting thing, I generally use this example for a lot of people. Deepti, I want to talk about this. Let's say I have an apple, correct? Let's say I have an apple seed. I want to plant this seed and become, let us say, big apple, correct? Big tree. I have now 100 apples here. Now, if I pay tax on the seed, and I also pay tax on the harvest, that is called taxable bucket. Because you keep paying, I paid the tax already, invested, money grown, I'm paying tax on the harvest again. That is called taxable. If we don't pay tax on the seed, I pay tax on the harvest only, that's called tax deferred account. I'm not paying tax on the seed. I'm paying only on the harvest. Okay, on the 1,000 apples or 100 apples, correct? If I pay tax on the seed, but I never pay tax on the harvest, is called tax advantage bucket. That includes municipal bonds, Rath IRA, 5 to 9 plans, 7702 plans. All of them are, you are not going to pay tax on the harvest. You can take this seed again, plant another apple, make another tree, doesn't matter. You are never going to pay tax on the harvest. Basically, that's why if you understand the importance of this, you may decide, you know what, it makes sense for me to put money here or money here. Basically, especially this is the open enrollment time for a lot of people. It is important to choose IRA 401k was Rath 401k. So if you have any questions on this, correct, you can set up another meeting, maybe 15 minutes call with us. So we can actually, I'm happy to help you about what are the difference between 401k and Roth 401k? When do you choose 401k or Roth 401k? We can talk for 15 minutes to help you understand how to choose open enrollment coming up for a retirement side of it. Now, last one I'm talking about is the taxes, correct? This is, look at this history of taxes from 1913 to 2021. At some point of time during World War II, we have, see this one here, 92% income tax, 92%. And more than 50, 60 years, we have 60% income tax. Why? Why it is dealing with 60% income tax? We are talking about 30% will be, oh my God, I'm paying a lot of taxes. But 60% income tax for more than 60 years. Why it is leading there? Look at the history. When the public debt, the debt to GDP ratio is increasing, debt to the America, correct? When it is increasing, the taxes are going up. When debt goes down, we see that taxes are going down. Correct? When taxes go up, debt go up, taxes go up, debt goes down, taxes are going down. So currently, where do we stand? Where do we stand today? Maybe I want to quickly talk about US, there's something called US debt clock. Maybe you can see this one. This is real time. These are real time interesting numbers. It's very powerful to see. Today's debt is $28 trillion, $29 trillion. Is increasing every second. See this one? Every second the debt is increasing, basically. So look at this one. What are the percentages here? 125.96%. US federal debt to GDP ratio is 126% already. Correct? Now going back to our presentation, let's go back to our presentation here. What are the percentage here? What we saw? 121% in 1944, which cost 94% income tax. Now the debt is already 124, 125%. Are we expected to have higher taxes? Absolutely correct. That's what all the predictions, everything is happening is people are worried about, I don't want to put money in 401k now. Can I put money in Roth 401k? Why? This will help them not to pay taxes anymore because future the taxes are going to be higher. A lot of people are doing Roth conversions. Coming from IRA, they're moving all the money from IRA to Roth IRA. Why are they doing it? They want to save taxes in the future. They don't want to pay a lot of taxes, basically. Because of the way the money is growing, the debt is growing, people are worried about it, basically. Okay, I will skip this because it will take save time for us. Now, last one is inflation, the fourth factor, correct? Look at this one. The Bureau of Census, the new home, average price of a new home in January 2000 was 194K. Okay, but what they said is it should in based on the calculators, what they said is it should be around 297. Okay, from 2020. Year 2000 was 194. As the Bureau of Census said, by 2020, it should be 297 based on the inflation and growth and the stuff. But actually see in January 2020, it is 400K, 35% more than what we expected. The market is growing like that. Not market, is inflation is growing like that in the real estate market. Right? Same thing with the car. They expected in 1999 was $20,000. They expected to be $31,000, but actually it has $37,000 now, basically, correct? Again, 14% higher than what expected. The last one I have is the salaries. People said 1999 they had $42,000 household income. They're expecting it should be around $65,000, but actually, if you see the median is around $63,000, which is less than what they projected. The cost of living is increasing, but your income is not increasing. Most of the people in America, correct? Even myself, I'm a full-time, I have a job. You look at last year because of pandemic, we didn't get any lot of bonus. We got any minimum increments. Always is like that, correct? So important things to understand: inflation versus how the money is growing or growing, correct? If you look at this interesting one, let us assume this: you have $50,000 your annual expenses today, correct? In 10 years' time, assuming only 3%, not even 5.3%, only 3%, your expected expenses will be $67,000. If you have $50,000 expenses today, in 10 years' time, you need $67,000 to have the same lifestyle. Okay, because of the inflation. In 20 years, we need $90,000 for expenses. Same lifestyle, basically, correct? In 30 years, we need to have $121,000 per year. So why I'm saying this is, when you're calculating for retirement, don't calculate how much you're spending today. You should project yourself 30 years, what is the inflation? How much I need to have? Can I save money for this kind of thing? As long as your money is growing at least more than 3%, 5%, you're on the right track. Otherwise, whatever the money you have, you're not even going to take care of inflation. Correct? Inflation is 5.3%. We're going only with 3 or 4%. We're actually losing money there, basically. Correct? It's important to understand the inflation and cost of expense, cost of living for us, and then plan for that one, basically. Yeah. So,
but we know about real estate, stocks, mutual funds, everything. But can you please talk more about on 7702?
yeah, so that's the good, Deepthi. Basically, 7702 kind of basically, as I mentioned, is a tax code. So in IRS tax books, 7702 is a tax code like 401k, 510 plan, those kind of things. 7702 is completely driven for life insurance, cash value life insurance policies, basically, correct? So I want to take a deeper dive onto that, 7702. So before that, I want to talk about a little bit of stock market trends, correct? If you look at S&P 500, S&P 500 is basically the top 500 companies in the US in terms of the net worth, correct? Basically. So the S&P 500 index from year 2000 to 2012, if you look at this, I'm talking about 12 years here. In 2000, year 2000, there was 49% loss market, basically, correct? And it took almost 5 years to get back to break even. They have to grow 101% to grow back to break even. Again, there's 2008, 56% loss. It took another 3-4 years to get back to break even. If you look at this one, there are some situations where when you put the money in 10, okay, I'm going to retire in 10 years. I'm putting, let us say, $1 million in my 401k. Even after 10, 12 years, you may have $1 million only. If you everything in one bucket, if you're putting everything in the stock market. That's why it's important to understand diversification. Where you don't lose money, how long you have for retirement, all the stuff is important. Let's assume this. I want to send my kids to the college. I have saved $100,000. I put into stock market. What if stock market crash like this? Can I take the money? Probably not. I can't take the money. But my son is going to college. So what can I do? So important to understand what are the vehicles you should use, what are the risks you can take, and what is the horizon that you have for your financial goals. That's very important to understand. Okay. This is about stock market. Second thing I want to talk about, interesting here is, I also looking at, last time I was looking at, you know what, let me put some numbers together to make it make sense. I took from 1937 all the way till 2020, all the stock market growth, S&P 500, correct? All, I'm talking about almost 70, 80 years, correct? Look at this. If you look at average 10 years, 14%. I'm talking about 2010 to 2020. Now let us assume this year. What is the average 10 years in 2008? I'm talking about 1998 to 2008. Only 0.67% return. Inflation is much, much higher than this. Correct? Why I'm talking about this year is, we don't know whether you're going to get 14% average for last 10 years or you're going to get only 0.67%. It is completely dependent on the market, timing, and our emotional investment. Correct? People, what happens now generally, what most of the people I see is, market go like this, down, up again, correct? People say, oh, everybody is putting money in market, stock market. They start buying stock market here. Market goes to the peak. They don't know when to sell. When market starts going down, what happens? They're scared now. They'll keep waiting. Oh my God, I lost a lot of money. They'll pull out here. Now what happens? Market keep going down. Now market comes back up again because we are not too comfortable with these losses. We'll keep watching. What happens? We buy somewhere here. Now market keep going up, very, very happy. Oh, market is good. Do we sell here? No, we don't. Market goes again down here, correct? Interesting thing is, when you look at the difference between this and this, there is a survey done by JP Morgan Chase. The average return of an average investor, like people who don't know about stocks, mutual funds, what are the average return is 2% return per year. Just 2% in stock market. Whereas the stock market itself would have grown at 14%, But average return by the survey that did by 20-year survey by JP Morgan Chase is 2% for investors, normal investors. Why? Because the emotions. We don't know when to sell, when to put the money back, kind of thing. Basically, also timing, correct? If you put money in, let's say 1998, you even for 10 years average only 0.67. Let's say put the money in 2010, we would have got 14% return in 10 years. That depends on the timing is very important about this. Okay. Next one, I want to talk about a lot of people put money in real estate, correct? I want to give a different perspective. I was reading about it yesterday. I was talking about, you know what, I want to add this slide today for today's meeting. So America's pricing history in real estate. Robert Shiller, I was actually attended a conference last week by Robert Shiller. He's an amazing speaker, 2013 Nobel Prize in economics. He says the long-term US house price increase reflects inflation. Interesting. What does it mean? Whatever the growth that you see in real estate is as good as inflation. You bought a house for $500,000. You may grow 4% this year, 5% next year, 2% of year after. And the average growth of the real estate is as good as 3%, which is equal to inflation. That means you're not really gaining, appreciating anything. The appreciation itself is as good as your inflation, correct? So looking at these numbers, I also pull this number from 1965 to 2020. If you look at a five-year average in 1965 is 15%, correct? In 2020, 12%. That means the average growth that you are seeing is 2.4% here. Look at this in 2015. If somebody bought a house in 2005 and they sold in 2010, what is the average? Only negative 0.9%. Actually, they lost the money there, correct? So, do you know that out of 2008, where market crash, a lot of people sold the houses for, they filed bankrupt, they filed short sales and all the stuff. All these things, correct? What if you bought a house in 2000? They got 5.8% average return. Again, here, same thing. Timing, market. Can you predict it? Probably not. People like noble literates also could not predict what is the average, when the market is going to go down, market is going to go up. This is about real estate. The earlier one is about stock market. This is about real estate because most of Indian community, including me, correct? I bought multiple houses all over the US. So I like real estate because it's physically tangible. I use real estate as part of my diversification. Not really, you know what? I don't want to put money anywhere. I put money in stocks, ETFs, mutual funds. I have my 401ks. I also put money in real estate, life insurance. I diversify myself into many vehicles.
So, very quick question here. Sorry to interrupt you. I know. So you're talking about history. That's really good to make any analysis and estimations. But in the current world, right? So the 2020s and the last 1 year, 1.5 years, the market prices on the real estate market is kind of really spiked up. And it is not in 5%, 3% anymore. So the month you wait, you're seeing the number of increasing up to 10 to 12%, and maybe because of the demand supply, or maybe the trucks are not being ported, stacked at the ports, or whatever the reason it is. Now the market is more different than what the history was all about. I don't know whether the 2008 scenario will gonna come back immediately or no, etc. No. So can you please address that current situation more specifically?
So good question, Rajesh. So as I mentioned, correct, history is not will not repeat exactly the same way, but we'll learn from the history. That's how I look at it, correct? Can I say, oh, this is going to be 8% in future or negative 0.9%? I don't know that. One point I'm going to make here is, if your horizon is, let us say, 5 years, 10 years, understand the risk here. If next year the market is going to go up or not, I don't know. For example, my house is almost grown 30% last 2 years. I'm very happy as an investor. Or also my primary house also grew 30%. I'm happy with that. Question is it going to grow like this for next 5 years? Probably not. Basically, correct? So if it's growing, how much people going to really afford it, Rajesh? Another thing, I was reading about an article about why people are bought so much growth in last 1 year is very interesting article. Is a lot of people staying at home now because of the pandemic, a lot of work from home. Now they have more time to think about the house. So interesting is the statistics says people who want to buy houses 3 years from now, they had a plans of buying a house in 2024. They have plans of buying a house in 2022. all of them bought house in 2021 because they're sitting at home. They're able to have a conversation with the spouse. Let's go buy now. Another statistic says, another research says, Rajesh, if there going to be another pandemic like what we had in 2021, most likely people who want to buy house in 2025, 2026 are going to buy in 2022. That means the craze is going to be like this again next year. But there's no pandemic. Even the big research firms are saying this craze is not going to be like this. The craze is already over. Remember the first slide I talked about? 67% people think is a bad market for them to buy. 74% sellers say this is a good market for them to sell. There's already disparity there already, basically. So is it going to be crazy? No. If you look at all your real estate friends, like I have a lot of real estate agents as my friends, they talk about they have been very crazy for last 6 months. Now they're saying, coming back and saying, Giri, now I have some breather time. Let's talk about finances, basically, correct? So there's an opportunity. It is settling down now, slowing down, but is it going to grow like this? If you ask me, I don't think so. Unless there's going to be another pandemic that is going to hit us and then people are going to buy houses, which they're supposed to buy in 2025. Okay.
Yeah,
so
we have Naren here. Probably we'll take that as maybe subsequent conversation altogether alone. But
yes.
my to the point of conclusion that what I'm trying to convey, or to the point, right? Considering the current kind of situations, and as I said, the buyer's market versus the seller market, not about only the real estate, considering not only as a primary focal point. What are the again, I understand the diversity point that you're coming to, but what is the again? It's again independent for an individual perspective as well. So again, just looking at the live news yesterday, Puneet Rajkumar, who's at 46 age, right? He passed away. It's a very sad news. So life is all about how do you live, how do you plan, how do you make it all better for your family, for yourself, or for your family. Considering all of that and the current game plan, what is your directions and what is your advices in terms of the controller?
I frankly speaking, Rajesh, so there's not one cookie cutter answer for there's no tablet to give, okay, take this tablet, you're going to be everything good. I would say this way, correct? I was a novice 3-4 years back about finances. Now I gain a lot of knowledge in terms of how to do things. What I am doing now is following fundamentals. What are the following fundamentals means? Number one is dollar cost averaging. What does it mean? Market go up, down, doesn't matter. I'll keep putting money into stock market. That's number one. That's what I do. Number two is called diversification. When I say diversification, what I do, let us say you have an elevator. Okay, very good vehicle, very good elevator is there. It's very strong, right? Elevator can take you up and down, no problem. And we have elevator. This is elevator A. We have elevator B. It has 4 or 5 big ropes which can take you up and down. So Rajesh, which one you will pick? You pick elevator A or elevator B?
Obviously B. I like plan B, so I would like to go with B.
Simple. So what I'm trying to say here is I'm always like diversification. Look at my perspective, what I'm doing. I'm putting in stocks. I play with the stocks. I see the growth. I bought Tesla stocks and then they gone down, they came up. All the stuff, I do that. And I do have ETFs. I do have mutual funds. I do have real estate. I bought multiple houses in multiple states. There's another diversification. I have a lot of life insurance policies where they don't go down at all. They remote index products. They don't go down at all. When the market goes down, you don't lose any money. I'm diversifying into many things. I'm not saying there's a right or wrong. I mean, thing is, I'm going to try to follow the fundamentals. So number one is dollar cost averaging, diversification. Number three is asset allocation. You can read up. I don't want to spend time today because on this. Asset allocation is another concept. Number four is asset rebalancing. These are the 4 fundamentals people follow for any kind of investments, correct? So as long as you follow these fundamentals, instead of thinking that, oh, I'm very smarter than everybody else. People did PhDs, research, masters in finances, correct? A lot of people see, I made a lot of money in stock market. Okay. You are competing when stock market, you are selling, somebody is buying, or you are buying, somebody is selling. The other person who is selling is a PhD in economics who knows in and outs of stock market. Do you think we're going to beat them? I mean, I don't think I can ever beat them, frankly speaking. Basically, that's why I am my take on this is let me leave that job to somebody else. That's how I take it, basically. But do we not do anything myself? I do, because I want to see how the market grows and down. That's why I do stock market on my own, but I don't put everything in one bucket. I don't, basically. That's why I diversify myself.
What are the third and fourth one? First one is the DCA. Second one is the, I mean, can you elaborate on DCA? What is the
first one is dollar cost averaging. Second is diversification. Correct. Third one is asset rebalancing, asset allocation, and asset rebalancing. So these are the fundamentals, and people use it for all finances. In personal finances, they look at all those 4 things. You can read up on the internet. It'll be straightforward. What does it mean? How much money you should have on stocks? How much money you should have in CDs, bonds, those kind of things, basically. So I have another presentation on this, Rajesh, maybe for future. I have specifically about retirement planning. So maybe you can give that presentation to your Swara Media audience. Only talk about how do you plan for retirement, correct? What are the percentage you should keep in CDs and bonds? How much you should put in stocks? How the retirement is going to look like if you do the bad job? Those kind of things. I have a lot of slides on that also. We can talk about them. Yeah. Okay.
I want to, considering the time, just doing the time check. Would like to open the questions. If any of the audience or listener.
I think we'll derail them. I would say request to wait till the end. We put in the chat. Rajesh, that is better for us. Yeah.
Yeah.
We have a few more slides to go, and we can spend time on the Q&A at the end. Yeah.
Absolutely.
Yeah. Okay. So now I talk about the 770 that Deepthi asked, correct? So this is called Index Universal Life. What is it here? It has an insurance, death benefit. We have terminal illness rider. Let's say, what does it mean is, even the person is not really pass away. The death benefit comes only when the person pass away. Terminal illness, long-term care, critical illness is not required for a person to pass away. Even if the person is still alive, but they have health conditions, they can actually take the money from the plan, basic financial plan, life insurance plan. That's called living benefit riders, correct? On top of it, it has a cash value. What are the money that grows? That is tax-free. No taxes, basically, on the growth, like no capital gain taxes. Remember the third one, tax advantage bucket. Next one is downside protection. When market goes down, you don't lose money. You guarantee to get a floor. It could be 1%, 0.75%, or 0%. Depends on the company and products. They have a guaranteed floor. You never lose your principal. And upside potential, it can grow up to 15%, 20%, depends on what products you're choosing, correct? Market go to 20%, you get 20%. Market go on 15%, you get 15%. Market go on 10%, you get 10% growth in the market based on the S&P 500, not like, some specific stock. If S&P 500, that is top 500 companies in the market, gone 10%, you get 10%, basically, that kind of thing. On flexible saving, you can start putting $1,000 per month, you can put $500 per month. You don't pay anything for 1 month, or you pay for 5 years. Your kids gone to college now. You don't want to pay for a couple of years. Those flexibility is there in terms of flexible saving, basically. Correct? So what are the features of this 7702, correct? Number 1 is flexible funding. I talked about it. Number 2, long-term care terminal illness rider. I talked about if you need long-term care. Long-term care is totally different topic. Deepthi, it is a lot of people, I would say 99% people don't know about this. We can talk about this on another topic. It's its own topic itself. I mean, this is one of the biggest blind spot for Indian community at this point of time. We'll talk about that. And then tax deferred accumulation. You don't pay capital gain tax. Money keep growing in your account. No taxes on this. Tax-free access before 15.5. You put money in 401k, IRA. You can't touch it until you are 15.5. Correct? Whereas this account, you can access anytime. You want to take next year for buying a car. You want to take the money for kids' education. You can take it. Correct? No problem there. No taxes, no penalties there. No impact to financial aid. This is another topic we'll talk about. How do you plan to use this for kids' education? If you have money in stocks, mutual funds, you may not get a financial aid. It may impact your financial aid for kids' education scholarship. So we'll talk about that another time. I don't want to spend too much time on this. And then tax retirement. When retirement, you want to take the money out for retirement, like a pension, you can take it. Every year you can take $10,000, $20,000, $40,000. No taxes on this, basically, correct? And also asset protection. This is another important piece is, let us say if I have $1 million in my stocks and I have, let us say $500,000 in my savings, if somebody sue me for any reason, what happens? If the court goes in favor of the person, I have to, the court can come onto my savings, my stocks, my real estate, everything. The money in these accounts are protected from those kind of debtors, basically. So it is a life insurance. They can't take the money from life insurance, basically. So you are protected from losing the money. So different advantages are there with this product. If you look at this, you can use this for college saving for kids without impacting financial aid, unlike 5 to 9 plans. 5 to 9 plans will impact scholarships for kids. Next one, diversification of portfolio other than stocks and real estate and crypto. The second one, tax-free retirement income without impacting AGI during retirement years, correct? Social security will kick in. Your 401k will kick in. All of them considered as income, correct? Whereas this money that you're going to take from this is not considered as income. It is a withdrawal, no tax, no penalty. Next one, a lot of people give this a generational wealth. For example, in my case, every year I'm actually adding $1 million life insurance for myself. Why I'm doing that? I want to give multi-million dollar assets to my kids with no taxes. That's my goal. I can give my stocks, but they're going to pay taxes. If I give my real estate, they're going to pay estate taxes. But this one, no taxes for them. So I want to grow as a wealth and generational wealth, basically, correct? Another one is long-term care coverage and give peace of mind for the loved ones. Long-term care coverage is totally different one. We'll talk about that. In case somebody needs help for moving, eating, dressing, taking bath in their life, your health insurance will not pay the money. You have to pay out of pocket, from your pocket. 100% you have to pay. First 20 days, your health insurance will pay. 20 days to 90 days, you can pay the copay. After 90th day, you have to pay everything out of pocket. You know how much average cost, Deepti? It costs $90,000 per year in the US, out of pocket. If you have a $500,000 saving, you're going to exhaust everything in 4 years' time. So very important to understand the importance of long-term care. We can talk about that another time, basically. Okay. So now people ask me, oh, if it's so good, why don't I buy all of this, correct? If you look at this slide, this is very important to understand. CDs and savings gives a lot of security. You don't lose the money when market goes down, correct? But the growth is also very, very limited. We look at the individual stocks and mutual funds. They have high growth, high risk. Right? High risk, high growth. Here, low risk, low growth. Whereas this one in the middle has no risk, medium growth. If you see last 20 years, average is around 8% growth here. Remember that other one I shown in the first previous slides? It gone 14%. Stock market gone 14% last 10 years. This has grown around 12%. It didn't grow 14%. So it is not like stocks and mutual funds. Again, timing, correct? If you are looking for 20 years, stocks and mutual funds gave only 5.6%, whereas this one given 8%. So it depends on the timing again. So it depends on the timing. You want to use diversification, or you want, portfolio diversification. You don't want to take a lot of risk. There's an opportunity for you to consider this as one of the vehicles in your portfolio. Okay. So I want to dive into case studies, correct? So people ask me, how can I use this? We talk about all these good things. You talk about kids' educational planning. You talk about retirement. How can you use this? I want to talk about 2 cases, and then we'll open for a Q&A. This is one of the case studies. They have a family of 35-year-old, 33-year-old female. They have 1-year-old kid. Both are job. They have a job. They have a 220K income per year. They're saving about $5,000 per month. Okay. So they ask me, Giri, we have to save money for kids' education. How can I do it, correct? Can I leverage this? Number 1. Number 2 is they need additional life insurance. So they had $1 million term already. They want to have $1.5 million for life insurance. Also, they want to grow the money, tax advantage. They don't want to pay any taxes for the growth. They understand the tax advantage bucket, tax deferred bucket. They have 401k. All the stuff is good, correct? They also have stocks, bank, all the stuff. See, they have 500K stocks. They have 150K 401k. They want to grow tax-free money, diversification, correct? So what I propose them is, I ask the spouse to take 350K, the 7702 life insurance permanent life insurance policy. I want you to follow, all of you to follow this. Little bit numbers, a lot of numbers here. The spouse is putting $500 per month. That means $6,000 per year for 18 years. So how much they put? Total 108K. Okay, $6,000 per year for 18 years. Now the protection that they have from 350K, it become 510K here. Correct? Look at this one, 510K. They put to 108K total. Now they stop paying anymore. No more paying. They paid only for 18 years. The 1-year-old daughter become 18 years now. Now they want money for kids education. So for their, based on their numbers, they need $35,000 per year. They're taking $35,000, 4 years, they're taking 140K. So they put 108K into the plan. They took 140K out from the plan. No taxes, no penalty. This money is not considered an asset. Is not considered an asset for the financial for a kids educational planning. When they apply for a FAFSA application, this money 160K is not considered as an asset. So they may get a scholarship also, financial aid also. On top of it, if they want to take the money, they can take $30,000. They didn't pay anything here. Now look at this one. The family still have a protection all the way till 85, 90 years. Interesting thing here is they put 108K in total. They taken 140K out. They didn't pay any more after this. They still have a coverage all the way till they are 90 years. This is one case that I'm talking about. A lot of people talk about, oh, I want to save money for kids education. What can I do, correct? Without impacting the financial aid. This is one way of doing it. Second example I have is, he's my friend from Sacramento, actually, Rajesh. He's 48 years old, 40-year-old female they have. They have 2 kids, 18 years and 16 years. They have a lot of money now. These numbers are kind of 1.5 year old. Now we have a lot of money. So his goal is he won't retire early. He don't want to wait till 65 to retire. He want to retire 56, 57. He had to say, I want to retire in 8 years time. And he want to give long-term care. He worried about long-term care because he's in medical field. Something happens to him. We know the importance of long-term care. He may have to spend hundreds of thousands of dollars. He won't take care of long-term care. And also he want to give a legacy for the family. Correct? So what we did here is, look at this one. He took $2 million plan, $2 million coverage. If he needs long-term care from the day one, he has the $2 million coverage. He can take $40,000 per month to take care of his long-term care. How much he's paying? He's paying $96,000 per year for 8 years. He's putting 733K in next 8 years. Now, see this one here. He can take $45,000 tax-free money every year from age 57 all the way till age 90. Can you believe this one? He funded for 8 years. He has 2.5 million, 2.6 million coverage at this point of time. And he's taking $45,000 every year all the way till 90. Even after 90, he still have $500,000 protection. In case he needs long-term care at the age of 90, he has $500,000. If he pass away without using money, he has $500,000 going to the kids. Kids as a legacy, tax-free money. Correct? This is another example that I want to talk about here in terms of protecting the wealth. Retirement early, you want to give a legacy, you can give the legacy, and anything that beyond tax-free growth, basically, correct? All of that. Okay.
But do we have any restrictions to take long-term care, Giri?
So restrictions.
Anybody can take it, or?
Yeah, very good question. If yes and no, some companies don't offer long-term care for H1Bs. Some companies do offer it. There's one thing you need to understand: which company can offer. I can actually work with almost 50 different companies. So help. Basically, a lot of people are coming in. I'm actually helping them to talk about long-term care. Especially state of Washington passed a new rule last year saying that everyone having a W-2 income must have long-term care. No choice. If you don't take long-term care, they're going to charge 0.58% taxes on their payroll, basically. So hundreds of thousands of people took long-term care in Washington state. So every state is going to follow that. Deepti, is why I recommend all my clients talk about, take care of this long-term care when you are healthy, so that you don't need to worry about it in future, basically.
Okay.
Okay. So this is my last slide. So as I mentioned, correct, we spend an hour or so with us. Important thing is take action. That I hope you gain some information about taxes, importance of investment in terms of what factors should you consider, what are the available vehicles available. If you have any questions, this is the time to talk about it. I'm happy to answer any of the questions.
So we have one question from Sheikh Guri. A scenario where you have invested through age 55 in Roth, stocks, insurance, etc. What if you had moved back to India for some critical reason? How is this generally handled or be transferred?
Okay. So there are different vehicles, correct? For example, let me talk a good question, Sheikh. There's the biggest question most of the people ask me if they have kind of a H1B status or they're not sure about staying back here kind of thing. So everything is different. For example, you talk about CD, for example, let's talk about CD, correct? CD is something like a bank account kind of thing, correct? You can withdraw anytime and use it. You can go back to India, you can take it back with you. Let us say you have 401ks, for example, or IRAs. What happens? You leave it there. What will happen? Nothing is going to happen. It is growing like another asset class for you until your retirement, until you are 60. After 60, what if you come back here for your kids' education? What if you come back here? You can withdraw money for retirement. Or, you don't want to do that. You want to take the money out right away and go back to India forever. Never going to come back. You don't want to deal with this 401k here. What happens? You have to take the money out. There's going to be a penalty. If you take the money before 15 and a half, you have to pay 10% penalty. And you have to pay the taxes for the growth, basically. For tax for everything, taxes. So 10% penalty and taxes you have to pay. If it's a 401k. But if it is a Roth, for example, correct? If it's a Roth, okay? If you have Roth for more than 5 years, you can take all the principal, no taxes, no penalty. The growth part of it, you have to pay taxes and you have to pay a penalty. But let us say the 7702 that I've talked about today, correct? No need to take it. Same thing, wherever you live in the US or America, Singapore or Malaysia, Hong Kong, doesn't matter. You can access the visa exactly the same way. You can have a death benefit wherever you live, doesn't matter. You can access the money wherever you live, no problems, basically. Hope I answer your question, Sheikh. You can unmute yourself and you can talk if you have a further question on this.
Yeah, he got it. He said thanks. Okay.
Okay.
So all if you want to schedule session with one-on-one with Giri, please reach out to us. We can schedule the meeting. It's free, no cost. You can talk to him directly on one-on-one. One more question, Giri. So what are the risks involved in investing in cryptocurrency? I heard that it is illegal in some countries. Is it true?
Yeah.
The question is from Keshava.
Keshava, so I'm not an expert in crypto. I personally did not put anything. And a lot of people, I know a lot of people made money, a lot of people also lost money, correct? So there is no specific rule available on crypto. Some countries are actually recently, a couple of weeks back, they banned really the crypto side of it. And a lot of companies, for example, in Europe, there are multiple, two, three big companies actually closed the shutter. They just ran away. There's no rules around crypto. That's why, and also let's say if I want to buy Amazon stock, for example, correct? I know this. I'm not saying I'm kind of biased maybe because I don't believe. Personally, I don't believe in crypto. I didn't invest anything there. Or personally, if I buy Amazon stock, I know what Amazon doing good job in terms of Prime or delivery and acquisitions. I can say, you know what, my stock market is going to grow. I'm going to make more money. If they're not doing good, I'm going to lose money. There is no basis for crypto. That's my take. And as I mentioned, correct, Robert Schiller, remember the Nobel laureate? I was actually having a question with him 3 weeks back. Question is, what about crypto, correct? He started laughing actually. Crypto is an amazing idea. It's an amazing idea. It's a fun game, basically. So there's nothing solid behind crypto. That's what his answer is. I 100% concur with his answer. So again, I'm not advising you to buy, or I'm not advising it. If you ask my opinion, I'm just to give my opinion. Just the disclaimer there. I'm not an investment advisor in crypto or stocks. This is my opinion. Just letting you know.
Yeah, that's all. Please type here if you have any questions.
Okay, Rajesh, you want to have you have questions? Any questions? I ask you to hold on to the end.
I do not have any specific questions, but so I'm sure most of us would be in a similar kind of a situation where where everyone go through the kind of a phase whether the investments, if I do it here, can I carry back to India, or because considering the uncertainty situations, how does it would be impacted on that? But I think you answered that part already. But I would like to thank each and everyone who's been in the call, and I'm sure you would have benefited with this last 1 hour of interaction with Giri. I'm sure if you would like to have a further conversations, feel free to ping us. It's easy to connect us on on WhatsApp or messages, or even Giri's Calendly invite is kind of already presented here, calendly.com/Lankipalli. You can ping them. I think there is a question from Rajesh.
Yeah, we have one more question, Giri. So what are the best ways to invest in index stocks?
Yeah.
Through financial institutions or tax advisors?
Yeah. So Rajesh, this index stocks are different than what I shown here. Basically, the index stocks is, let us say you want to go to S&P 500 VOO. What people generally do is they use platforms like Vanguard or Fidelity and then buy those index stocks. But they can go up and they can go down. You know that basically. There's no exactly same like stock market mutual funds, correct? There's no difference there. Index units I'm talking about, the way which has a guaranteed floor, has to go through the advisors that like me, basically. It is not a product that you're buying. It's basically you're buying an insurance product. I'm talking about this going back here, correct? We're talking about this one, which has downside protection, upside potential. So when market goes down, you always get a 0% or 0.7%. When market go up, you get the S&P 500 index account, basically. So market S&P 500 go on 8%, you get 8%. A simple example here, let's say I put $1,000, example, an S&P 500, I got 10%. What happens? Now my account becomes $1,100. Next year, my market lost 10%. What happens now? This will become $990. Correct? This is S&P 500 or stock market, correct? This is basically. This product I'm talking about here is, if this situation comes, what happens? You got 10%, you get 1,100. Good. The market lost 10%. What happens? 1,100, they get 0%. You don't lose money. That means you're going to stay at 1,100. So next year, now 990 is there. Now we go on, let us say another 10%. Now what happened? This is not 1,100 yet, correct? It could be around, let us say 1,090. I'm just giving some number there, 1,090. Now what happens here? Your number here, 1,100, 10% growth here. You are going to go 110% growth here. 110. So to again 210 here. So that is the difference between the real S&P 500 index and this life insurance product here. So you don't get the losses, you only get the growth. And what is the catch here? Right? The catch here is these companies have a cap. What if market grown 25%? Stock market can give 25% to you, grow, good job. Here, they cap at 15%, 20%. You don't grow beyond that. Even if the market goes 20%, you get only 15%. Market grows 20%, you get 20% down, not beyond. That's the catch here, basically. So they're giving the floor, guaranteed floor, but there's a cap in these products, index universal life products. Hope I answered a question on this.
Yeah, we have one more question. Any insight you can provide on HSA?
Very, very good question. I really like it. There's one of my favorite topics to talk about HSA, especially because of the open enrollment period. I really want to take advantage of this. Okay, a lot of people HSA. This is taxable, correct? Remember the example. I have an apple. I have a tree harvest here, correct? You pay tax here. You pay tax here. This is taxable. If you don't pay tax here, you pay tax on the harvest. This is tax advantage. You pay tax in the seed. You don't pay tax on the harvest. It is called tax advantage, tax defer, correct? HSA is a special category. You don't pay tax on the seed. You don't pay tax on the harvest. Only special category is HSA. So I always request people to maximize HSA. Number one. So I want to talk a little bit more deeper on HSA. Number one is triple tax benefit. What does it mean? When you put the money, $6,000 into your HSA account, you're reducing your taxable income. One tax benefit there. When you can invest this in index funds in HSA account. Whatever the money it grows, capital gains, no capital gain tax. Another benefit here. Third one, when you take the money out for medical expenses, no taxes, no penalty. Another tax benefit here. So it has triple tax benefit. Number one. Number two is it don't expire every year. You can roll over every year from, let us say, 2021 to 2022. You don't, like FSA, you have to exhaust everything by end of the year. But HSA, you don't need to exhaust. It can continue growing. Number three, interesting thing is, this is a new concept I am promoting myself with a lot of my clients. Even if you have money in HSA, don't use it for health expenses. Keep it there. Keep growing it forever. When you become old, you need more money anyway for health and why don't you use that money later on? So I'm trying to not to use the money. For myself, I'm growing my HSA account. Correct? I'm not even touching even $1. I want to put all the money, max out, want to grow this. Good thing about this, let us say 10 years from now, I have a difficult situation. I don't have enough money in my savings to take care of my medical. I can actually reimburse all 10 years, man. So I'm keeping all my receipts for 10 years. And I'm talking about 20, 30, 31. If I want to reimburse from all the years, I can actually reimburse for myself. Great, correct? No penalty, no taxes. Another great thing here. Number four, I want to give advantage here is, once you become 65 years, you can use it not only for medical, you can also use it for your living expenses, like 401k. But the only caveat here is you have to pay taxes, no penalty. But whereas for medicals, no penalty, no taxes. So there are a lot of advantages being HSA. I hope I answered your question. Whoever asked the question, I really like HSA and I promote it a lot to my clients. Personally, I enjoy HSA. They're one of the best accounts available, best plan available in the financial market. Basically.
Thank you, Giri.
Yeah, thanks, Giri. Yeah. Just a follow-up question, if I'm not taking too much time. Can just like explain an example like the 7702. This HSA, can it be transferred to kids upon your death or something like that?
Good question. So if you have a 7702, this is a life insurance, correct? Basically, okay. It is if you have a long-term care on top of 7702, there are some products exclusive for long-term care. Sheikh. There are some products in 7702. They only focus on long-term care, nothing more. For them, you can actually fund from HSA.
Okay, got it. Thanks.
So any other questions? So if you have any questions, so if you want to talk one-on-one, please, you can schedule one-on-one with Giri.
I'll go back to the this one. Yeah.
Yeah, take a screenshot of it, or probably you can ping us. It's already available on open on YouTube and YouTube and Facebook. So we'll help you to facilitate the further conversations. So feel free to leverage our services. Thank you again. Thank you all for making this happen on a Saturday. And I'm sure most of you must be getting ready for Halloween Eve, maybe today or tomorrow. But thanks for making it on a Saturday and spending time to make your funds for future and investing your time on learning more on this. Thank you. Thank you all. Thank you, one and all.
Especially thank you, Giri, for your time. I know you are busy with all the time, but you gave us some time to educate people. Thank you so much, because everybody needs this one. So thank you. Thank you so much.
Thank you, guys. Have a wonderful weekend.
Thank you all.
Thank you all.
Thank you.